Let me tell you something that nobody in this country wants to say out loud, something that financial advisors whisper about behind closed doors, something that the IRS absolutely does not want you to know before you walk out of that office for the last time and think that you are finally free. Because here is the brutal, uncomfortable, jaw-dropping truth that is going to change the way you think about retirement forever. The moment, and I mean the exact moment, that you retire, the IRS does not forget about you. The IRS does not wave goodbye to you. The IRS does not let you ride off into the sunset with your pension and your savings and your Social Security check without watching every single move you make. In fact, and this is what keeps me up at night, retirement does not make you invisible to the IRS. Retirement makes you more visible. Retirement puts a spotlight on you that is brighter, more intense, and more dangerous than anything you faced during your entire working career, and if you are not prepared for what I am about to tell you, you are going to lose money, you are going to face penalties, and you are going to spend the years you worked your entire life for fighting a government agency that has infinite resources, infinite patience, and absolutely zero mercy. Now I need you to stay with me, because this is not a scare tactic. This is not some dramatic nonsense designed to get your attention and then deliver nothing. Every single word I'm about to say to you is grounded in real IRS behavior, real tax code, and real stories of real retired Americans who thought they were done, who thought the hard part was over, who thought that decades of working and paying and contributing meant that they had earned the right to be left alone. And they were wrong, dead wrong, financially devastated wrong. And I refuse to let that happen to you. The first thing you have to understand is what happens to your income picture the moment retirement begins, because this is where most people make their first catastrophic mistake. When you were working, your income was simple. Your employer withheld taxes, they sent in the payments, they handed you a W-2 at the end of the year, and as complicated as it felt, there was a structure holding you up. The moment you retire, that structure disappears completely. Suddenly, you have Social Security coming in, and yes, depending on your total income, up to 85% of your Social Security benefits can be taxable, and most retirees have absolutely no idea this is happening to them. They see that check come in and they think it is theirs, all of it, clean and free, and then tax season arrives and they are staring at a number they never anticipated and wondering how this happened. It happened because the IRS treats your combined income differently the second you stop working, and if you are also drawing from a pension or an annuity at the same time, those income streams stack on top of each other in ways that push you into tax brackets you never expected to occupy in retirement. And that brings me to something that is even more explosive, something that the financial industry talks about so casually that people have become completely numb to how serious it actually is: required minimum distributions. If you have a traditional IRA, a 401k, a 403b, or virtually any tax-deferred retirement account, the IRS has been waiting patiently for decades while your money grew, because they always knew that one day you would have to start pulling it out. Once you reach the age threshold, you do not get to decide whether or not to take that money. The IRS decides for you. You must take a minimum distribution every single year, calculated based on your account balance and your life expectancy, and every single dollar of that distribution is fully taxable as ordinary income. Miss it, miscalculate it, or take out too little, and the penalty is so severe it should make your hands shake. We are talking about a 25% excise tax on the amount you failed to withdraw. 25%. Gone, before you even get a chance to spend it. And if you think this is something that only happens to careless people who do not pay attention, think again, because the rules around these distributions have changed, the deadlines have shifted, the calculations involve tables that are updated periodically, and the IRS is not going to send you a reminder. They are going to sit and wait and let you make the mistake, and then they are going to collect. Now let us talk about investment income, because this is another area where retirement changes everything, and most people are completely blindsided by it. When you retire, many of you shift your financial strategy toward income-generating investments, dividends, interest, capital gains distributions from mutual funds, bond income because you need your money to work for you now that your paycheck is gone. And on the surface, that makes perfect sense. But what happens underneath the surface is that the IRS begins scrutinizing your investment activity with a level of attention that it simply did not apply when you had a salary, because now your entire financial life runs through those investment accounts. Every dividend is reported. Every capital gain triggers a taxable event. Every sale of a stock, every redemption of a bond, every distribution from a fund adds to your taxable income for the year. And if your combined income from Social Security, pensions, distributions, and investment returns crosses certain thresholds, you trigger something called the net investment income tax, an additional 3.8% tax on top of your regular capital gains rate, and suddenly, the beautiful passive income strategy your advisor built for you is delivering far less than the projection suggested, because those projections did not always account for what the IRS was going to take. But here is where it gets truly infuriating, truly stomach-turning, and I want you to hear this with complete clarity, because this is the piece that makes people genuinely angry when they finally understand it. Roth conversions. If you are moving money from a traditional IRA into a Roth IRA during retirement because you want tax-free growth going forward, which is a perfectly legitimate and often brilliant strategy, every dollar you convert is counted as ordinary income in the year of the conversion. Every single dollar. And if you are not extraordinarily precise about how much you convert each year, and in what year, and in relation to all of your other income sources for that same year, you can accidentally push yourself into a higher tax bracket. You can trigger the taxation of a larger portion of your Social Security benefits. You can lose access to certain deductions and credits that phase out at higher income levels, and you can actually end up owing significantly more to the IRS in the short term than you ever would have if you had simply left the money alone. The irony is almost unbearable. You are trying to save yourself from future taxes, and you accidentally create a massive tax event right now. And the IRS collects immediately with zero sympathy for your intentions. And I have not even gotten to real estate yet, which is the area where retired Americans are perhaps the most dangerously uninformed. Millions of people in this country own rental property, and they carry it into retirement thinking it is a golden asset, a stream of passive income that will support them through their later years. And it can be. But the IRS looks at rental income from retired individuals with extraordinary interest because the rules around passive activity losses, depreciation recapture, and self-employment tax in retirement are genuinely complex, and the line between passive investor and active real estate professional carries enormous tax consequences. If you are spending more than a certain number of hours managing your properties each year, the IRS may reclassify your activity in ways that affect how your losses and gains are treated. And if you ever decide to sell that rental property you have held for 20 or 30 years, the depreciation you claimed over all those decades gets recaptured and taxed, often at a rate of 25%, in addition to capital gains tax on the appreciation, and the total tax bill on a property sale that feels like a windfall can be absolutely staggering if you did not plan for it years in advance. I want you to feel the weight of this, because the people who built this country, the people who worked 40 years and saved and sacrificed and deferred gratification and did everything right, those people deserve to keep what they earned. They deserve to understand the system they are operating inside. They deserve to know that retirement is not the finish line. It is the beginning of an entirely new game with entirely new rules and an opponent who has been playing this game far longer than you have and who never, ever, ever makes mistakes in their own favor. The IRS does not make computational errors that result in you paying less. The IRS does not accidentally forget to collect. The IRS does not look the other way because you are 72 years old and you worked hard and you just want to be left in peace. So, what does this mean for you right now, today, before you retire, or if you have already retired, starting immediately? It means that the conversation you have been putting off with a qualified tax professional is not optional anymore. It means that the assumption that retirement simplifies your taxes is one of the most dangerous financial myths ever told to the American public. It means that the gap between what you think you will have in retirement and what you will actually have after the IRS is finished with you can be tens of thousands of dollars, and in some cases hundreds of thousands of dollars, over the course of a 20 or 30-year retirement. It means that your Roth versus traditional strategy, your Social Security claiming age, your RMD planning, your investment income structure, your real estate decisions, all of it needs to be coordinated, all of it needs to be stress tested against the current tax code, and all of it needs to be revisited regularly because the tax code changes and the IRS changes with it. You earned this retirement, every single day of it. And I am telling you with every ounce of conviction I have that the difference between a retirement spent in genuine financial freedom and a retirement spent constantly hemorrhaging money to a tax authority that never sleeps comes down entirely to whether or not you understand what I have told you today and whether or not you take it seriously enough to act on it. The IRS is watching. They have always been watching. But the moment you retire, they are watching 5 things about you with a level of focus and precision that most people never see coming. And the ones who see it coming, the ones who prepare, the ones who plan, those are the ones who actually get to enjoy what they spent a lifetime building. Do not be the person who finds out too late. Be the person who acts right now.